Here we go again, another market crash, and it really didn't matter what kind of cryptocurrency you bought. Everything is down. It's not about asset selection, it's about figuring out the macro. And so this is what this video is all about. Trying to find out where are we currently in the cycle, where is a potential bottom, and are we going to continue, or was this it? The issue is that this was not just a drop of the top altcoins. This was a drop across the entire market. Every altcoin category, the top 100, but also the 100s to 200s, the 200s to 300s, they are all pretty much 10% down today. And this has happened for quite a while. This is the others dominance, so how much of all of crypto is in the altcoins that are not in the top 10. And since the beginning of December, the altcoins in aggregate underperformed by 24%. Now, if you did worse than that, then that's probably because you bought the thing that was hyped in the moment, because those kind of tokens are now bleeding the most. What has gained in the last 7 days? It was only just Coin and Mantra and Monero, and how much of a gain? Pretty much nothing. It's single digits. While on the other side, we had the official Trump token that performed the worst across the top 100 cryptocurrencies. A loss of 34.6%. We are now at $21. And this happened while Bitcoin still stayed somewhat stable. Yes, we didn't go up, but we are still relatively close to 100K. Jelly went down 46% in the last 24 hours alone. Altcoin went down by 29%. And so as a consequence, the Bitcoin dominance went up, right? Bitcoin lost less than the rest of the market. So the fraction of all of crypto that's locked up in Bitcoin tends to go up. But there is of course correlation, right? When Bitcoin goes up, the altcoins go up as well and vice versa. So let's have a look at the Bitcoin cycles, because indirectly they do also impact altcoin prices. Have a look at this comparison of the different cycles. The first one from 2011 to 2015, that made a 552x. The subsequent cycle from 2015 to 2018 made more than 100x. Then the returns are diminishing from 2018 to 2022, still at 20x. And so far, from the bottom of 16K to our current prices, we had a 6x. It would be reasonable to assume that we're not going to see another 20x, right? The market cap of Bitcoin is growing over time. It takes more and more capital to move the price. And so the concept of diminishing returns would tell us that it's very unlikely that we're going to see the 20x, or let's say the 18x, another 3x from here. We are probably not going to end this cycle at 300K. When we just look at this chart, we might have already seen the top. From 110 to 550 is roughly a 5x. From 20 to 113 is also roughly a 5x, a bit more than that. From 6 to 30, we already have more than a 5x. In other words, maybe we've already come in higher than we should have. Now, let's say we are still in a bull market. Let's say we have not yet topped out. What are the kind of drawdowns that we should expect? Let's say we continue to rise to 150 to 200K. How much could we still drop in the meantime? The reason why this question is so important is to not get shaken out of the market, or to potentially sell when the trend turns around. Have a look at this overview. Again, we're looking at the different cycles. By the way, those graphs are taken from the Glassnode Insights newsletter. A new article is published roughly once a week. And what we see here in those colored regions is how much does the price go down even if we are in a bull market. And this tends to be quite different for those different cycles. So the right scale shows us the percent drawdown. In 2013, that was minus 62%. In the 2016 bull run, it was around minus 38%. Then interestingly enough, because of the COVID crash and because of the FTX collapse, we saw yet again another 62% crash. FTX only brought us down 50%. And the recent bull run, right, since the 16K, from 16 to 100K, actually has seen the least volatility. Times have never been that calm. In other words, if you are down 60-70% with your portfolio, then it's probably really because you're overexposed to assets that you shouldn't be that much exposed to. Investing and trading is a game for the long term. It's a marathon. It's not a sprint. And so even if we were to drop again our 38%, maybe even 50%, it wouldn't really be out of the ordinary. So that would bring us to 70K potentially. Now, every 3 to 4 years, we get exceptional buying opportunities. Those buying opportunities happen when the market in aggregate is in losses. So most of the time, Bitcoin and crypto as a whole tends to expand, it tends to grow, the prices tend to go up. But sometimes people take profit. And as the trend turns around and we might enter a bear market, at some point we are that depressed that the selling pressure subsides and that it's then the dollar cost averagers, the people that buy into Bitcoin every month, that don't care about the price, that create the floor. And so this is a measure of the average cost basis. This is the realized price. Again, this is a very long-term chart, and whenever the price is below the realized price, it's an exceptionally great time to buy. This is when selling pressure subsides, when it's not really worth it to sell Bitcoin anymore because you're already down 70 or 80% and you're just waiting it out for the next bull run. So this happened over here during the minor collapse in 2018. It happened over here during COVID, and it also happened after FTX. Unfortunately, of course, because we've already seen quite a bit of a run up, that realized price is very far away from the current price. In other words, the market as a whole is still very much in profit. The realized price is now $42,700. At those kind of prices, it might make sense to even take on some leverage, to maybe even get a loan, to sell everything in your house you have to buy Bitcoin. This is not the case right now. Yes, the bull market might continue, but we are definitely not at historically low prices. And so instead of looking at the price development over time, we can have a look at the realized price development over those different cycles. Check this out. This is the 2011 to 2015 cycle. So that gave us a realized price increase of 122K. So the average market participant made a 122x. Then we had the next cycle. It gave us a 21x. So roughly 1/6 of the rally. Then the next cycle gave a 5.7x return for the average market participant. So that's roughly 1/4 of the return of the prior cycle. And so let's say maybe the next return is 1/3 of the prior cycle. Then we've already reached that high. So 1/5, 1/4, 1/3. I know this is not scientific, but it's some kind of a ballpark, right? It shows us that we shouldn't be that super bullish. We should sometimes take profit. If you're currently 80% in crypto and you don't have any precious metals and you don't have any cash, you don't have any property, you're only in crypto and especially you're only in altcoins, maybe it's time to reconsider. Maybe it's time to learn out of this. I'm currently holding more gold than I am holding stocks. I think stocks are very expensive. I talked about this several times on this channel. I do, of course, have my Bitcoin allocation, but I always try to keep this within a target range, right? I don't want to have 50% of my money in Bitcoin, but I also don't want to have just 5% of my money in Bitcoin. There is a healthy middle ground, and that middle ground should be renegotiated wherever you currently see we are in the cycle. If you currently think we might be relatively high in the cycle, then the target allocation should be somewhat low. If you currently think that we're very low in the cycle, which for example is true when we are below the realized price, then the target allocation can be higher, right? Then maybe it's not good to just have 10% in Bitcoin, but maybe 30, 40, 50% is reasonable at those times, not now. Have a look at what long-term holders and short-term holders are doing. Short-term holders tend to buy when prices go up. They get excited about those new all-time highs, and the long-term holders, they take profit. They reallocate to other asset classes. Once the price crashes down, then the short-term tourists exit the market, they all get burned, and the long-term holders, dollar cost average into the market, they get the Bitcoin for comparatively cheap. So we have to be careful whenever the short-term holders increase in numbers. That is when Bitcoin topped at around 60K. That is also when Bitcoin now topped at around 100K. We aren't as high as we used to be in the past, but that's because the number of short-term holders tends to decline also with every single cycle, because Bitcoin gets more and more owned by the investors and less by the speculative money, right? The speculative money goes into altcoins and then get burned over there even more than they would get burned with Bitcoin. There's also another way to look at this. We can just look at the ratio of short-term holders to long-term holders. So that's this line in blue. And again, when we are crashing down, we should take profit as well. And whenever we are high, we should potentially buy. Currently, we are rather at the lower end. In other words, time to take profit if you haven't yet. Now, full transparency, I was a bit early in taking profit. I sold roughly 1/3 of my Bitcoin 1.5 months ago when we were at 96K. We then went above 100K. Now we're coming back down. I'm not yet back in the market. I'm waiting further for the price to drop. I don't think that momentum is that bullish just yet. Now, there is a story that Bitcoin will always go up because over time, the balance on exchanges will go lower and lower as well. And even the exchanges can't buy BTC anymore. But I don't think that's true. We can see the balance on exchanges here in orange. And yes, it's not growing, but it's also not shrinking that much either. We are at similar levels to where we had been when Bitcoin was at 3.5K. As long as Bitcoin's price is going up, the balance on exchanges is also going up because then the long-term holders move their money from their self-custodied wallets to the centralized exchanges to cash in. What we've got over here is the balance on exchanges and the ETF balance that's held in custody by Coinbase, because Coinbase is the custodian for most of the ETFs, not for all of them. And here we see how the decline is even less pronounced because, again, money is flowing into crypto through the ETFs, but the ETFs are not creating the cycles, right? The ETFs are just a long-term supporter of the price, helping Bitcoin appreciate over the next cycles, but it's not going to stop the Bitcoin price from correcting by 30, 40, 50%, right? For that, we've got the long-term holders taking profit and the short-term holders exiting the market. When there's very, very little attention on crypto, at the same time, the long-term holders take advantage of the high prices. That's then what leads to a potential bear market. I talked about this several times before on this channel. I have back tested several moving averages, and I like to buy whenever we are above the moving average, and I like to sell Bitcoin or even short Bitcoin when we are below the moving average. And we aren't yet in a confirmed bear market. We are still above the 120-day SMA. So it doesn't make sense to take all chips off the table. It still makes sense to have a reasonable allocation to Bitcoin. But there might be a point not so far out in the future where things could turn around. Let's arbitrarily extend that SMA. If Bitcoin just stays at the current levels and doesn't rise this month anymore, then we might enter a bear market. Then I will sell even the rest of my BTC. Yes, some Bitcoin maximalists say that you should never sell Bitcoin, that you should always hold it because it's the hardest of the monies. But this only applies if your wealth isn't yet several years of your income, right? Let's say you've got 5 years of your income and you put this all into Bitcoin and you ride this through all the waves. Then your wealth fluctuates from 1 year of income to 5 years of income to 1 year of income. That's way too much fluctuation to sleep well at night, right? There needs to be some kind of risk mitigation, and that can be by timing the market with things like the 120-day simple moving average. It can also be by being somewhat diversified across asset classes with things that are not highly correlated to Bitcoin, for example, gold. So the more wealth you have relative to your regular cash flows, the more important it becomes to not just own a simple risk on asset. If you're very young and you've just got a few months of your income saved up, then by all means buy it all with Bitcoin. And if it then drops, then feel free to buy even more, right? Because then your regular cash flow is high enough to buy the bottom and still have an impact. If you have 5 years of income saved up and that drops by 4 years, and then you buy the dip with your regular cash flows, you will not really recover that quickly because, again, your wealth is large relative to your income. So this ratio really matters. I'm talking more about those kinds of concepts in premium. The link is down below. It's thebitcoinstrader.com. I also talk about my view on the current market regularly over there. There's a new video every 3 to 4 days. So looking forward to seeing you over there. There's also an introductory video on premium on the website. So see you in the next video. Feel free to subscribe in case you haven't yet. Feel free to also give this a like. It helps the channel grow. See you in the next video or see you in premium. Cheers.